Hi folks, this is Sean Hyman from Chart of the Day, and I want to talk to you about a special indicator that is unique, that I've never seen anywhere else really, and it's called the Speculative Sentiment Index, SSI. Say that 3 times fast. That's a mouthful. And it can be found at dailyfx.com, DAILYFX.com, dailyfx.com. And it's in their SSI section, Speculative Sentiment Index. I can trade with it, but can't say it today. And what you do is you look for extreme readings, which are greater than 3.00, which is a positive, or flipped on the negative side, greater than negative 3.00. And what does that mean? What does that reading mean? It means, for instance, like we've got dollar CAD. Let's just take a real-time example. Dollar CAD has an extreme reading. It's the only one out of the bunch right now that does, that is greater or less than 3, greater than 3.00 positive, or less than 3.00 negative, that is. And so we've got our 4.33 reading here, and what that means is there are 4 times as many people that are long dollar CAD than are short. So in other words, there are 4 times as many buyers of dollar CAD in the retail space right now than there are sellers. And when I say that, the retail public meaning about, which is their database, which is about 150,000 accounts that they're looking at collectively, retail accounts specifically. And the thought is, if the retail public gets so distinct and they're so adamant about one position, and we know that most of the retail public is wrong in their trading, and that the masses lose, and it's the few people that make money, then there's a good chance that you should look for the opposite side of the trade. So let's put all this together. So we got dollar CAD at 4.33. It's the only one that's an extreme reading of greater or less than 3.00. It's at 4.33, so 4 times as many buyers than those that are short. So they're adamant about buying this thing, and that it's supposedly got to turn around in their opinion. However, here's the problem. They're fighting the trend, and this is what retail public traders do. In the retail public, they tend to fight trends. They are bottom pickers and top pickers, meaning that they're trying to pick a bottom in a downtrend and pick a top in an uptrend. So they're trying to short an uptrend, they're trying to buy a downtrend, which is totally stupid, but that's what they do. And so you can tell that the trend is down because over here at the left of the chart, it's high up, and over here at the right-hand side of the chart, it's low down. So we're coming from the upper left to the lower right of the chart. You can put on something like a 50 or a 200 period simple moving average and see the slope in the direction of that, and that'll tell you as well. So overall, prices are dropping. The trend is down on the daily chart. This is a daily 1-year chart, and so there's more chances of a trend continuing than there are for a trend reversing. If you look at multi-year charts, take a daily 3-year chart and go through a ton of pairs, count the times that you see a true trend change to where the moving average really shifted from being up to down or down to up on, say, like a 200 period simple moving average. And you'll find that it really usually only happens 1 to 2 times within a year or 2 or 3. And sometimes it doesn't even change that much. I have seen some trends that lasted several years and never changed trends. So a trend is more likely to continue than it is to reverse. And if you just trade with that trend, that alone gives you an edge. However, when you look at this SSI reading and you see that the people are stacked on one side of it, 4.33, so the number of buyers is just enormous. So they're trying to pick a bottom here, but we know that the trend is more likely to continue than to end. Here's the thought. If the trend does continue on and they're loaded to the hilt as buyers, and the trend keeps going against them and going against them, that means they're going to lose money. If they're losing money, it's eventually going to hit either their stops, or it's going to take them out through a margin call, or they're going to get scared out and cash out of their position and take their losses, or they're going to reverse their positions and finally get on the right side of the market. Any one of those scenarios is going to add fuel to the fire, help the trend to continue, and help to propel your position all the more into profitability. So In these instances, it's my opinion that it's when you have a strong trend and you have a strong SSI reading, it's good to trade against the crowd, trade against the masses, and you're kind of playing the role of the market maker there. Really, you're taking the other side of the trade of the retail trader, and you know as well as I know that the market makers tend to do a heck of a lot better than the actual retail traders. So this is one of the only times I've ever seen where you can really see a decent shot at what positioning is and kind of know how the crowds are focused on where they're at. Now I'm putting a slow stochastic indicator on there with a 14.33 setting, and that's no magic to that. It's just settings I like, 14.3 and 3 on a slow stochastic. And so we determined that the trend was down. We determined that the crowd is fighting the trend, and so we would want to look to enter in the direction of that trend on a sell signal. And so as the lines come up, cross, and come back down out of this 80 region, which is the dashed lines here, once that comes up, crosses, and comes back down out of 80, you get a sell signal. Now, had we been looking for uptrends, which we're not, the lines would come down, cross, and come out of the 20 region, which is right here, this dashed line, and come up out of there would be a buy signal. Since the trend is down, we only want to take entries that are sells. And so we could sell here, and we'd have done well. We could actually sell right here, which is a recent one, which is starting. Could have sold here and caught this downward move. Could have sold right in here, which right in here we'd had been patient for a handful of hours before we got our drop, etc. So, and you'll notice these are some pretty huge moves to the downside. And why are these huge candles, like that? It's because the crowd is getting their clock cleaned. I mean, they're getting stops blown through, they're getting margin calls, etc. And so the passion, the movement, the momentum to the downside is enormous. And so I hope you've learned something here today. You can go to dailyfx.com, check out their SSI indicator, look for extreme readings of greater than or less than 3.0. And especially when they are against the trend, that's my other requirement, because they're bottom picking or top picking. When they're so notably to one side, look for it, and it doesn't mean instantly go in and take the other side of their trade, but what it does mean is go to a near-term chart, 1 hour or 4 hour chart, and look for a signal that is the opposing side of their trade. So if they're buyers, we would want to be sellers. If they were sellers, we would want to be buyers. So in this case, they were buyers, so we would want to be sellers and take any stochastic sell signal that came about here, and we would have a high probability trade. Now, nothing is fail-safe, and neither is that sentiment gauge as well. If you trade with the trend, you're still going to have some losses. It's just that you've got greater odds on your side that you're going to win. If you trade with the sentiment gauge, it is simply that, an indication, and you're going to more likely win more than you lose once you get practice with that. But so nothing is 100%, but I'm going to tell you, I've traded with that for years now and had really good success with it and really enjoy that, and that's why I wanted to pass that nugget along to you guys. Thanks so much for watching. Bye-bye.